meeting of October 26th to order. We'll take the second item first, the investment report for September 30th, 2010. Oh, no, you can? Okay, we don't need anybody else. Steve will do the Housing Authority grant, 233 West Ortega Street.
Okay, thank you, Chair. I'm Stephen Falstish, the Housing Program Supervisor, and the request before you is that the Finance Committee review and approve a proposed grant of $300,000 to the City Housing Authority for construction of 2 new units on their property at 233 West Ortega Street. It's property at the corner of Bath and Ortega, and is currently developed with 4 3-bedroom units already, but there is some nice available land as part of the parcel that's not used very much, and they want to take this opportunity to maximize the affordable housing opportunities and construct 2 new units on this land that they already own. These would be 1-bedroom units. And the project has already received all required city development permits. They have a funding gap of about $300,000, and they're coming to the City Redevelopment Agency asking for this in the form of a grant. Now, the city and agency generally try to provide our financing in the form of loans, even if they're residual receipt loans deferred until the cash flow from the property, maybe years later, can start paying back the loan. But in some cases, a grant is more appropriate. In this case, the site was purchased and developed by the Housing Authority in the early 70s or in the 1970s using HUD Public Housing Program funds. And they have strict regulations. The HUD does. The U.S. Department of Housing and Urban Development has strict regulations on properties that are developed as public housing, and one of them is that they can't take out additional debt on the property. So because of this, we need to structure this request, if approved, as a grant. And HUD is going to be funding $320,000 of the total $620,000 development cost. And so the city is asked to provide the other $300,000. That would be $150,000. And these 2 new units would remain affordable to low-income renters for indefinitely, basically. And so this will enable the Housing Authority to leverage the $320,000 that they're already receiving. The city has sufficient housing set-aside funds in the agency's reserves to provide this requested financial assistance. Rob Pearson is the Executive Director of the City Housing Authority, and he's here if there's any questions that I can't answer.
Any questions from committee members? Mr. Francisco.
Thank you, Mr. Chairman. So did this project go before Planning Commission?
No, I don't believe it had to go through Planning Commission. It's apartments, so it didn't need a subdivision approval.
Okay.
Right.
And so what kind of review did it get? Who looked at it?
Right. I believe it went to the ABR and
Staff hearing officer.
There was staff hearing officer and ABR.
And were there any objections from the neighbors? Okay.
No.
All right. Thank you.
Any other questions, Councilmember Self? And I guess I think I know the answer to this question. Usually our typical city subsidy for a given project is about $110,000 per unit. This being a little bit higher than that is usually to do with the economies of scale because we're only building 2 units. Is that the correct?
Yes. Chair Williams, actually the per unit subsidy is a little higher than usual for this, but we've gone higher than $150,000 per unit even in some recent projects. But there's a couple of things that make it more expensive here. One is the fact that the units have to be raised off of the ground in order to, because they're in a flood plain. Another is the economy of scale is not really there with only 2 units. And another big factor that we always look at is what's the source of the other funding. Now, one of the things that should keep the subsidy low is that this is on land that they already own. So that's really great, and it's great use of their land resources. They are getting subsidy from HUD on this, but so many of the projects lately we couldn't even go forward with unless they got low-income housing tax credits, and that wouldn't be appropriate for a project of this small size. Usually they're much bigger in scale. Very competitive program, and so without the tax credits, we're always going to be looking at a higher subsidy than usual.
Thank you, Mr. Falstich. Can I get a motion on the recommendation?
I move that we recommend to the full council to approve the expenditure of RDA funds for the $300,000 grant for this project.
Is there a second?
I second it.
All those in favor, please say aye.
Aye.
Opposed? The
Thank you.
recommendation is unanimous, Mr. Falstich. And then we'll take item 2, the September 30th investment report. Ms. Tora.
Great. Good afternoon, Chair Williams and committee members. I'm Jill Tara, Treasury Manager, and I'm here today to discuss the September 30th, 2010 investment report and fiscal agent report. As a quarter-end report, I'll go through some of the key economic events over the quarter, and then we'll turn our attention towards the city's investment activity during the quarter and look at and examine some performance measures related to the portfolio performance in response to some questions from committee member Francisco. So after a significant slowdown in financial markets last quarter, the financial markets all posted double-digit gains this quarter in response to improving consumer confidence, a jump in existing home sales, lower jobless claims, and a general easing of concerns over a double dip in the recession as the economy appears to have stabilized, although there are some concerns that it may stall out and we may turn into a deflationary period. Fueling the favorable results in the financial markets over the quarter, the Fed indicated that it was willing to provide additional accommodation to support the economic recovery, which means it's planned for November 3rd for the Fed to go out and buy back a bunch of treasuries that are out there. That'll reduce the supply in the market, driving up the prices and driving down yields, keeping interest rates low, hopefully to continue to spur growth in the economy. Over the quarter, the Fed left the Fed funds rate, which is the overnight rate that banks charge each other for federal funds to meet the reserve requirements. That was left at a 0 to 0.25% in continued efforts to spur growth in the economy. Although it's still very low levels, CPI was up for the third straight month over the quarter at 0.1% in September due to gains in both the energy and food indices. When you look at the core CPI only, which excludes food and energy, core CPI was flat, though, in September. National unemployment figures remained high at 9.6%, coming off of a 9.7% unemployment level at the June 30th quarter, so pretty flat there. Why don't we turn to the investment yields table, which shows both the Treasury market yields and the LAIF rate down at the bottom for the quarter. This is shown on page 2 of the agenda report for those of you that have the agenda report at home. Treasury yields, as you can see, across the board steadily declined over the quarter as investors continued to demand the safety of Treasury investments, and the increased demand for those drove the prices higher and therefore yields lower. If you look at the one-year Treasury, that was down 5 basis points. The cumulative change over the quarter from June 30th to September 30th. And the 5-year Treasury declined 52 basis points. So what we're seeing is a continued flattening of the yield curve as investors expect that this economic recovery to be slow and protracted and for things not to get better anytime soon. Right now, economists forecast that rates probably won't turn around and go up until the end of end of calendar year 2011. So we're looking probably another year plus of this low interest rate environment. If we turn to a table which is shown at the bottom of page 2 on the investment report, and I've shown it up here on the board excerpted it from the agenda report. You can see over the quarter that we purchased $14 million in AAA-rated federal agency securities, a combination of Federal Home Loan Bank securities and Fannie Mae's. 12 million of the purchases were in callable securities, where we were able to get a little bit more in terms of yield based on the risk that those might be called according to a specific schedule by the issuer. And we purchased one 4-year bullet. That's the third one listed there, the Federal Home Loan Bank, and that was a yield to maturity of 1.375. Over the quarter, we had $9 million in calls of callable securities and maturities of $11 million, including one corporate note. That's the Wells Fargo $2 million note there that was called. We only have 2 corporate notes remaining in our portfolio at this time, and due to uncertainty in the environment or in markets, we're just not buying corporates right now until things really stabilize and return to normal. The next table is the investment yields table, and it'll look familiar to you, but I've changed it a bit in terms of what I presented, what I typically present at a quarter end, to try and explain a little bit about our performance over time. So while I typically bring this for the last 4 quarters, I've expanded this to go all the way back to September 2007 and compare the city's portfolio to the 3 other benchmark indicators that we compare ourselves against. And I chose back to September 2007 because that was right when the recession hit and we started seeing yields just begin their steep descent. The top line there, the green line, I don't know how well you can see the colors, represents the LAIF rate. And the next line down, the red line, represents the city's portfolio yield. And that corresponds to how much money we're earning on our investments that we have invested. The lower 2 lines, the next one being the brown one, corresponds to the 2-year Treasury note. And we choose that as a benchmark indicator because the 2-year Treasury length roughly corresponds to the weighted average maturity or length of our average holdings in our portfolio. So it seems to be a good comparison for us. And the blue line corresponds to the 90-day Treasury bill or T-bill, and that's would be a LAIF alternative. But generally, we put our overnight funds and our cash, the cash portion of our portfolio, invested in LAIF. And as you can see, you get quite a pickup by doing that. On September 2007, the 90-day T-bill was at 3.8%, and the LAIF rate was 5.25%. So if you look back to September 2007, you can see historically this is about what the picture looks like in terms of how our own city portfolio performance, or in terms of yield, compares to the other benchmark indicators. We hover right within 1% or so of the LAIF yield, either up or down, and in this case in September 2007 we were a little bit below the LAIF yield, but still significantly above the 2-year Treasury yields, being the 2-year and the 90-day T-bill. You can see over time that the Treasury yields as well as the LAIF yields really dropped off during this 3-year period during the recession, while our city's portfolio did better over time. So by the time you get to September 2010, you can see that the city's overall yield was 2.138, which was roughly 164 basis points over the LAIF rate. And there's a couple reasons for this. First of all, we invest in the 1 to 5 year range, which means that we've tied up our investments, our cash, in terms of the notes that we're buying for a longer period of time, therefore earning a higher rate of return. The LAIF yield, their portfolio is roughly 6 months in length, and so it's much more responsive to substantial declines. And so as their securities are turning over more quickly, they're more responsive. They're recognizing those lower market rates right away. So over this period, as we continue to hold some of those older investments bought at a higher period of time, we're really outperforming our benchmarks. But I caution that once rates turn around, the Treasury and the Treasury yields and also the LAIF yield will turn around more quickly, and we could see all of those indicators outperforming us until our longer term securities that we're buying right now at low rates mature, and then we're able to buy back in at higher market rates. So we look really good now. There'll be a time where it's going to flip a little bit, but overall the pickup in interest income in terms of buying longer-term securities and buying callables to mitigate the interest rate risk have worked for now. If we turn to the next table, we can put it in perspective, because ultimately the yield is driving how much we're earning on our surplus assets, and that's really one of the key objectives of our whole investing program is to maintain liquidity, ensure the safety of our surplus assets, and then to earn a fair rate of return on those assets so we can use that interest income to expand the services that we provide to the public. So you can see in September of 2007, the portfolio yield, as you saw in the previous chart, was 5.028%. So for a total portfolio of roughly $153 million, the interest earned in that month in September 2007 was right around $651,000. 3 years later, we've got a portfolio with roughly $2.5 million more invested at $155.6 million. The portfolio yield has dropped from 5.028% to 2.138%, and the interest earned that we earned this most recent month was $278,000. That's roughly 42% of what we were earning 3 years ago. So you can see such a substantial decline in yield really makes a huge difference in the amount of money we're earning on our portfolio. I wanted to note that you can see the base portfolio WAM, or weighted average maturity, shown in days there. We've lengthened the portfolio a little bit out closer to 2 years, boosting the rate that we get a little bit. And I also showed the total portfolio WAM, which includes the 20-year airport note that Council approved in 2009, which skews the number a bit. So now I present two numbers so you can see the base invested portfolio as well as the overall with that 20-year note in there. And I will remind the committee that the airport note, the outstanding balance is roughly $6.1 million. There's, I think, 18 years left, and we're earning 7% on that. So it's a good investment for our portfolio, especially in these times. On to the next table. It summarizes the interest revenue that was earned on the investment portfolio over the quarter, and you can see the total over to the right. The total on the pooled investments for the quarter was $856,431. The interest earned on the RDA's cash held up at the LAIF account at 0.5% interest over this quarter was $24,568 for total interest earned on the portfolio of just under $1 short of $881,000. So I will note that the fiscal agent report, which shows the balance of the bond funds held with trustee agents, is shown on attachment 3 in the agenda report, and I'm happy to answer any questions you might have.
Are there any further questions from members of the committee? Can I get a motion on acceptance of the report?
I move that we not only accept, but we put a gold star on this investment report and forward it to the full council.
Well, thank
Can I
you
get a
very
second?
much.
You get a gold star second.
All those in favor, please say aye.
Aye.
And we're adjourned. Thank you.
Thank you.